It started quietly. No alarms on the street, no sudden panic in the branches, no crowds demanding answers, just a short notice, a few carefully chosen words, and then silence. This bank didn't survive. It wasn't merged. It wasn't rescued. It wasn't given time. It was liquidated. And when liquidation happens, it means the system has already decided there is no way back. For years, this bank appeared solid from the outside. Customers deposited money believing it was safe. Investors trusted balance sheets filled with confident language and polished numbers. Employees showed up every morning assuming tomorrow would look much like today. Stability, after all, is what banks are meant to represent. They are not supposed to feel fragile. They are not supposed to disappear. Yet history has shown again and again that when a bank fails, it rarely looks dramatic until it is already over. Liquidation is not a single moment. It is the final chapter of a much longer story. Long before the official announcement, cracks usually form beneath the surface. Sometimes those cracks come from risky investments that go wrong. Sometimes they come from sudden changes in interest rates that turn once profitable strategies into losses. Sometimes it's poor management decisions layered on top of an unstable economic environment. Whatever the cause, the result is the same. Assets stop covering liabilities, confidence erodes, and the math no longer works. Banks survive on trust more than anything else. They do not keep everyone's money sitting in a vault. They lend it, invest it, and move it through complex systems designed to function smoothly as long as people believe in them. When that belief weakens, even a healthy-looking institution can unravel quickly. Depositors withdraw funds, credit lines tighten, partners step back. The bank is suddenly forced to sell assets, often at a loss, just to stay afloat. In this case, those losses mounted faster than expected. Assets that were once considered reliable no longer held their value. Loans went unpaid. Investments failed to perform. Each attempt to stabilize the situation required selling something else, and each sale brought in less money than planned. What looked like a temporary problem became a structural one. Regulators took notice, not because they wanted to shut the bank down, but because their role is to protect the broader financial system from collapse. When regulators step in, the goal is often to save the institution if possible. That can mean finding a buyer, arranging a merger, or providing temporary support. Liquidation is the last option, used only when there is no realistic path forward. It is an admission that keeping the bank alive would cause more harm than closing it down. By the time liquidation is announced, the decision has already been made behind closed doors. Liquidation means the bank's remaining assets are sold off. Cash, property, securities, loan portfolios, everything is evaluated and converted into money where possible. That money is then used to pay creditors in a strict order. Secured creditors come first. Unsecured creditors come later. Shareholders, almost always, come last. In most liquidations, shareholders receive nothing at all. Their investment is effectively wiped out. For customers, the experience depends heavily on deposit protection systems. In many countries, insured deposits are protected up to a certain amount. That protection is designed to prevent panic and ensure ordinary people do not lose their savings overnight. Insured depositors are typically paid back quickly, sometimes within days. Uninsured amounts, however, may be tied up in the liquidation process for months or even years, and full recovery is never guaranteed. Employees are often caught in the middle. Jobs vanish suddenly. Pensions and benefits can become uncertain. Years of loyalty and routine end with little warning. While headlines focus on balance sheets and market reactions, the human impact tends to fade into the background. A bank failure is not just numbers collapsing. It is lives being abruptly redirected. What makes modern bank failures especially unsettling is how fast they can happen. Digital banking allows money to move instantly. Confidence can evaporate in hours. A rumor spreads online, withdrawals spike, and liquidity disappears before leadership can respond. Traditional safeguards, built for a slower era, struggle to keep up with the speed of modern finance. This is why liquidation feels so final. There's no dramatic rescue at the last second, no heroic turnaround, just an acknowledgement that the system has reached its limit. The bank stops operating. Accounts are frozen or transferred. Signs are removed. What once felt permanent becomes a case study. Yet these failures rarely exist in isolation. Each liquidation raises broader questions. Were warning signs ignored? Were regulations too loose or too slow to adapt? Did market pressures push institutions into taking risks they couldn't manage? After every collapse, promises are made to learn lessons and strengthen safeguards. Sometimes those lessons stick. Sometimes they fade as memories grow distant and confidence returns. For the public, bank failures can shake faith in the entire financial system. People begin to wonder whether their own bank is truly safe, whether numbers on a screen actually mean security, whether stability is as solid as it appears. This uncertainty is why authorities often try to manage the narrative carefully, emphasizing containment and protection. Panic, after all, can create more damage than the original failure. But understanding liquidation matters. It reminds us that banks are not invincible. They operate within economic realities, human decision-making, and imperfect systems. Growth can hide weakness. Success can mask risk. And when conditions change, even large institutions can fall faster than expected. This bank didn't survive, not because one thing went wrong, but because many things aligned at the wrong time. Pressure met vulnerability. Confidence met doubt. And once the tipping point was crossed, there was no reverse gear. Liquidation was not a punishment, it was a conclusion. In the end, the story is not just about failure. It is about fragility, about how systems built on trust must constantly earn it, about how stability is not a fixed state, but something that must be maintained, monitored, and respected. The bank is gone, but the lesson remains, quietly embedded in the financial landscape, waiting to be remembered the next time everything seems calm. Continue. Even after the doors close and the headlines fade, the effects linger in subtle ways. Markets adjust, quietly recalculating risk. Other banks review their own positions, looking for similarities they would rather not find. Investors become cautious, at least for a while, weighing optimism against memory. A liquidation sends a signal that travels far beyond the institution itself, reminding everyone that safety is conditional, never absolute. For regulators and policymakers, the aftermath becomes a careful balancing act. On one hand, they must show firmness, proving that failure has consequences and that poor decisions are not endlessly protected. On the other, they must reassure the public that the system still functions, that one collapse does not mean many will follow. Too much reassurance can feel dishonest, too little can spark fear. The response is often measured, controlled, and deliberately calm. Behind that calm, however, is deep analysis. Reports are written, timelines reconstructed, emails reviewed, strategies dissected. People look for the precise moment when recovery became impossible. Sometimes it's clear, often it isn't. Failure in finance is rarely a single mistake. It is usually a chain of small decisions that seemed reasonable at the time, reinforced by short-term success and ignored warning signs. What makes liquidation especially sobering is that it removes the illusion of permanence. A bank can exist for decades, woven into the daily lives of its customers, sponsoring local events, employing generations of families. Its name becomes familiar, almost comforting. Liquidation erases that presence in an instant. The name becomes historical, mentioned only in past tense. For those watching from the outside, it can feel distant, almost abstract. Numbers move, charts dip, news cycles shift. But for those directly affected, it becomes personal very quickly. Access to funds matters. Paperwork matters. Timing matters. A missed payment, a delayed transfer, a frozen account can ripple outward, affecting rent, payroll, tuition, and livelihoods. Stability, once assumed, becomes something to rebuild. Over time, new institutions fill the gap. Accounts are transferred. Services resume under different names. The system adapts, as it always does. This adaptability is often cited as proof of resilience, and in many ways it is. But resilience does not mean immunity. It means the ability to absorb damage and continue, even if something is lost along the way. The story of liquidation also challenges a common belief that size alone guarantees survival. Large balance sheets can create confidence, but they can also amplify mistakes. Complexity can hide risk just as easily as it can manage it. When things go wrong, scale can accelerate collapse rather than prevent it. As time passes, the failure becomes a reference point. Analysts mention it in comparisons. Educators use it as an example. Future warnings are framed with phrases like, "This is not unlike what happened when that bank was liquidated." Memory becomes part of the system's defense, even if it slowly fades. And that fading is perhaps the most dangerous part. As markets recover and conditions improve, caution softens. Risk becomes acceptable again. The lessons of liquidation turn into footnotes, until eventually another institution reaches a similar edge, convinced that this time is different. This is why understanding what happened matters more than the name of the bank itself. Liquidation is not an anomaly. It is a feature of a system that allows growth, risk, correction, and failure. It is the line drawn when repair is no longer possible. This bank didn't survive, but it did leave something behind. Not buildings or branches, not logos or slogans, but a reminder. A reminder that trust must be earned continuously, that stability must be actively maintained, and that behind every calm financial surface lies a complex structure that can, under the right pressure, give way. When the next announcement comes, quieter than expected, using familiar language and careful phrasing, it will feel sudden again. But it won't be new. It will be another chapter in the same ongoing story, where systems endure not by avoiding failure entirely, but by confronting it when it arrives, closing what cannot be saved, and moving forward with lessons that are always learned, and just as often, slowly forgotten.